name is Hao. Fantastic. Grad corner students. We have very interesting operation management, and we also have the airline and other majors in the finance and global. I have a great talk for some topic. So in the next 10 minutes, they will present what they have lined and their research project. Afterwards, we will have a lively discussion with our two panelists for another half an hour. And in the remaining of the time, feel free to jump in with your questions.
So we are jumping to the literature review first. We read like many different journal research as well as articles when writing our paper, including papers mostly from recent years, from 2019, 2021, and 2023, to stay in current trend with the current ESG conversation trend in the executive conversation. So based on our research, as you can see, the overall ESG conversation adoption rate has increased globally and also domestically in the US. And the trend is especially prevalent in developed economies and industrialized economies such as France and Germany. And ESG contracting is an important topic of research because it has been found to show many benefits to both the business itself and the society. So as you can see here, ESG contracting reduces toxic carbon emission, as well as driving innovation and increase employees' productivity and improve allocation of R&D budgets. And we also recognize the importance of a country's cultural and institutional environment in the company's decision of whether or not to adopt ESG compensation initiatives. So now let's move on to the next slide. So we just added in a bit of like a recent update given a new presidency. So on April 8th, 2025, President Trump ordered a review of climate laws in some democratic led states. And it shows some political resistance to the ESG linked compensation. And we found it interesting on how it might affect some future trends in like the ESG adoptions in companies that are headquartered in democratic states. So our research question is, to what extent does political affiliation influence companies' adoption of ESG linked in executive compensation policies? So our hypothesis is that because mostly democratic states have stricter laws regarding sustainability and more incentives to business that adopt like this kind of policy. So our hypothesis is that democratic states are more likely to have ESG linked compensation compared to Republican states. But we need to test out to see using data points if that's true or not.
So in order to testify our hypothesis, we actually randomly selected 71 companies from utility, energy, and extraction industry, as these industries are closely related to environment and also the ESG criteria are often mentioned in their annual reports. So from our preliminary analysis, we found out that their headquarters located in 28 states in the United States, and they also demonstrate upward trend in terms of adopting ESG incentive with their executive compensation. So at the meantime, we also found an interesting thing is that 14% of these companies which adopted this approach also discontinued from 2009 to 2024. And therefore, I will pass to Ara to tell more about the further research work and analysis with it and what we found.
Thank you, Eric. So after conducting our analysis, we've discovered a couple of interesting things. First and foremost, companies in democratic states are adopting ESG related compensation at the highest rate, and then Republican companies are adopting at the lowest rate, which matches our hypothesis. Now, the interesting thing here is that companies in swing states have the highest discontinuation rate, and we believe that this is because there's increased uncertainty regarding political laws and the policies in that state, which sort of implies that there is political influence over the adoption and discontinuation of ESG related compensation. And we wanted to further analyze, comparisons between Democratic and Republican companies. We looked at the adoption rate over the 15-year timeline. And overall, you can see that both companies in Democratic and Republican states are increasing very quickly, especially over the last 5 years. But I want to point out the election years. We look at 2016, when Donald Trump first came to office. There was one company in the Democratic state that had the issue with competition, and they discontinued. If you look at 2020, you'll see that when Biden came into the office, companies in the Republican state saw a dip in ESG-related compensation. And the same thing happens in 2024. When Trump came into the office for the second term, you see a dip by companies in Democratic states. So there seems to be a trend that whenever the opposing party is in power, companies in that state are more likely to discontinue. Now, there are a couple of caveats with this. First, the data is very small. I mean, if you look at 2015, there's only one company in Democratic state. That isn't enough to have a lot of fruition behind this trend. And then the second caveat is, if you look in 2020, companies in Republican states do see that dip. However, they also see an increase starting in 2022 and 2023, similar to Democratic companies. So whether the dip is due to COVID-19 related effects and the cutback on compensation, or if this is another example of the trend that we're seeing, that remains to be seen, and we need more analysis to be done. And especially in the next 3 to 4 years, as Trump's policies set in, it'll be interesting to see whether companies in Democratic states continue to discontinue.
Thank you, Aura. So how our findings can be related to the topic of the summit, which is short-termism. So we believe that the shift in political party or political affiliation will actually drive companies shift their focus from the long-term strategy for investment in ESG to more about short-term financial returns. So we believe there are two combination of factors or reasons. First is government inconsistent support on ESG criteria. So the shift in political affiliation often bring uncertainty or instability in regards of ESG policies. And for companies, predictability or stability is kind of important when making their long-term strategies. Therefore, when facing their kind of uncertainty, they will be more likely to mitigate this risk and avoid making strategies around the risk. And also, when making long-term strategy, investors or let's say shareholders is a huge part when considering this business strategies. And for shareholders, financial returns or dividends is from most of case is their priority when they look at company's performance or company's future. Therefore, by combining these two factors, we believe companies in the future will more likely to mitigate this risk from the inconsistent ESG policy and more likely to relocate their or reallocate their resources towards short-term financial returns. So moving on to the limitation of our research, like Arab said before, we still need more data to be analyzed to validate our conclusion. So after our further analysis, we also conducted a correlation analysis as well as the significant test to see if the finding we got is statistically significant. So from the table here, we can see both p-values for both correlation or relationship between our variables are actually bigger than the default threshold, which is 0.05. So this actually shows that the findings we have so far is not statistically significant. And our assumption so far is because of the insufficient data points we analyzed, we probably need to have more data analysis to solidate conclusion. This also implies that our current findings cannot fully reflect the reality or the long-term trend, and also we need further validation with more research and data analysis.
Now, in terms of future outlook, a lot of this is contingent on the policy that Trump's administration has in. And so if there is greater support by the administration, we expect to see higher regulation. And this will be in terms of transparency and standardization. A lot of the times you see companies in their proxy, they'll have qualifiable data. So they'll say, for example, 20 years, the next 20 years, we want to pursue this, and this ESG initiative. There's not a lot of quantifiable data that we can analyze. So if there's more regulation, we expect to see a greater number of companies implementing ESG related compensation, and therefore we can calculate what sort of trends are really happening in this area. And finally, from a financial perspective, institutional investors such as BlackRock and State Street, they value companies that have long-term ESG initiatives and therefore ESG compensation. So when companies are implementing these policies and then in 4 years due to a change in presidency discontinuing them, then perhaps in another 4 years are re-implementing them back into their plan, there seems to be some sort of disconnect and instability for these companies. So companies should really look to implement long-term ESG goals, and therefore they would be able to garner more support from these sort of institutional investors. That concludes our presentation, and we will now move to the panel. Thank you so much. Hey, thank you for all being here. As mentioned, my name is Rob, and I am a senior at Questrom studying finance and global business. And I'm joined today by these wonderful panelists, Sinsen Wong and Charles Tharp.
I don't know.
I don't- You guys can all hear me, right? All right, thanks. So we'll start with Sinsen Wong. She is an executive director at MSCI Research. She is the head of America's Sustainable Investment Solution Research Team, and her research she conducts research on ESG and climate solutions, focusing on applied research and thought leadership on ESG and climate investing. She has served on the MSCI, which is formerly Morgan Stanley Capital Investment. She serves on She has headed the Austin office. Her prior experiences include Credit Suisse, the Federal Home Loan Bank of Chicago, Fannie Mae. She holds an MBA from the University of Chicago and graduated from Harvard Business School's General Management Program. And she's also certified in CFA and GARP FRM, which is Financial Risk Manager. For those of you who are interested in potentially pursuing that, you can reach out to her. As for Charles, he is a former BU Questrom School Business professor. He joined BU's Questrom team following an extensive career in human resources, including positions with General Electric, PepsiCo, Bristol Myers Squibb, where he served as the Chief Human Resources Officer. He has researched many topics, including executive compensation, the role that the CHRO plays in the compensation committee, and strategic HR leadership. And he's also worked with companies to develop and conduct executive education for senior management, board of directors, and HR organizations. And he has a bachelor's, master's, doctorate, master's of law, and a PhD. So lovely having you both here. I want to start off by asking you about your general thoughts on the topic at hand, short-termism, ESG, and any potential thoughts that you had about the presentation that Fiona, Eric, and I just gave. Charles, we can start with you.
Go first. Sure. Again, it's an honor to be here. Thank you. I spend all my day doing an exec comp sort of education boards and things like that. And ESG is a hot topic. Just a little update on some of the data. I had a chance to pull some of the new information. In the S&P 500, about 77% of companies have some form of ESG in their incentive plans, primarily in short-term incentives. That's declined a little bit, about a 1% decline last year. We don't know what it's going to be because the proxies are just coming out now. My guess, you're going to see a little more decline as some companies are starting to get a little more under the radar screen. So compensation and ESG have been historically very much linked. And before we get too excited about that, it's usually in the short-term plan. It's usually about 10 to 15% of the annual incentive plan. And for a CEO of an S&P 500 company, the annual incentive is about 20% of pay. So it's probably 2 to 3% of total pay. And you say, well, why would they bother putting ESG in if it's that small a percent? The answer is pay is communication. So when we go through our discussion today, the sort of bubble above your head, what I want you to think about, pay, although it's for incentive and it's to provide a link with strategy and all that, compensations, especially at the executive level, is a really powerful form of communication to a variety of audiences. So having it in there, no matter what percent of total pay it is, it's a signal to different shareholders, stakeholders, critics, advocates, that it's something the company's serious about. So never forget there's kind of two elements to pay. One's the incentive element, it's pay for performance. But at the executive level, it's really important to remember that it's also about communicating the image of the company, their values. And so even though it may not be the biggest percent of pay, I think companies in a very thoughtful way want to make sure they're sending that message. So that tends to be a pretty prevalent practice among large companies, a little less if you go to the Russell 3000 in terms of the prevalence, but still very important.
First of all, thank you for having me here. It's a pleasure. And I'm sorry to have you sit through the long introduction of all the acronyms. From my perspective, I've been in the industry from a practitioner perspective. So the way that we look at ESG and climate, these days we call it sustainability rather than ESG, because ESG now apparently is a dirty word. It's kind of funny, like we deal with a lot of clients in the red state as well as the blue states. Everybody's still talking about ESG and everybody's still talking about sustainability, but they changed the terminology. Like a lot of people would say, we don't call ourselves ESG research anymore. We call ourselves sustainability. Or some of them would tell us, look, we call ourselves stewardship. I'm like, what is stewardship? It's the same thing that we are doing, but we just changed the name. The reason I think you mentioned about backlash, a lot of uncertainties, as well as as you know, BlackRock, the CEO public, they have this annual letter and, they are very embracing ESG practices on many different fronts, and then taxes for $500 million, from BlackRock. Arizona follow suit. So it's really, damping their business at the same time. So a lot of business, what they're doing right now is really try to avoid that term. But from a practitioner point of view, long-termism versus short-termism is always something that company have to balance. The way that we look at it is from what we call double materiality. One materiality is from impact. So that is less of financial performance. The other materiality is what we call financial materiality. So it's purely from financial performance perspective. And when you talk about these two things, long-term, short-term also differ, like in terms of how people approach and evaluate. For impact, it's a lot less about short-term. It's a lot more about long-term. But for financial performance, it's a balance between the two. And a lot of times you may see, companies sacrifice the short-term, long-term for the short-term profitability and, quarterly earnings and to answer investor demand. So we have a lot of data. Our approach is very much data-driven. We have public company data as well as private company data. So a lot of things I'm about to share is all data-driven and not so much from, model or theoretical approach, but what we see from the data. So that's something I want to comment just to start.
I know you touched upon balancing long-term and short-term goals. How do companies go about balancing those, and what sort of factors play into that?
Yeah, it's that's a big topic, by the way. But maybe I'll give you an example, right? So we know what happened in the last couple of days, because the tariff liberation day on April 2nd, the global market has gone into a big sell-off, briefly paused on the 9th, right? And then dip again yesterday, the 10th. But if you look at the magnitude of the shock to the market because of the tariff, that was the same magnitude as we've seen on the COVID-19 pandemic. So people ask, and one observation I want to give you is that we look at companies, or in this case, investment strategy that prioritize ESG versus the companies or strategy that do not. And what we found, and by the way, we use MSCI ESG indices, what we found is that these indices outperform their benchmark during this very, very sharp sell. And there is a lot of empirical evidence support that in these market-wide systematic shocks, company prioritized ESG really outperform their peers that do not. So this is seen, many times, and then governance comes on top. So if you look at all of the ESG factors, and there are many of them, by the way, they can be anything related to environmental, can be related to governance or social. And by the way, social is really kind of misleading. It's about fundamental. Fundamental meaning like profitability, these type of things. It's not about woke. A lot of people are, equating social to woke, but it's not. As a matter of fact, DE&I is not even an attribute or metric that we include in our ESG assessment. So having said that, like company really prioritize their governance, they have a lot fewer extreme drawdown scenarios compared to companies who do not. So like if you look at 50% or more drawdowns, company prioritize, like 7 out of the 11 sectors, company prioritize governance outperform. So they have much fewer extreme drawdown events. So if you ask me like short-term versus long-term, in the scenario that just happened, you would say, prioritize ESG definitely because they make company more resilient. But it's not something that you can do in a very short period of time. A lot of these programs have to be in place for a long period of time, has to see the payoff. And, so that's where I would like to comment on.
Yeah, it's interesting in compensation arrangements, the most prevalent ESG metric is the social and human capital metric, usually employee safety, DEI. And it's kind of interesting, the market drop, if you think of where ESG is most prevalent, and I think the study that our students just did, it's utilities, minerals, our real estate, interestingly, and energy. Those are generally defensive stocks. So when the market really goes down, you tend to get a little protection. So there's sort of a correlation between the nature of the industry and their interest in DEI and also their investment profile, because those are long-term investments. You don't buy a utility because you think it's going to go through the roof. Very high dividend yield, very stable. So I think kind of connecting the dots of what are the factors that are really important is going to vary tremendously by industry. Technology has the lowest incident of using ESG and the most, again, back to more regulated and more long-term stable. I spent most of my career in pharmaceuticals. And how do you make money in pharmaceuticals? You all study different industries. It's your pipeline. Those are long-term. It takes about 7 years to bring a drug to market, about $600–700 million investment. And so industries have different timeframes, and of course that's going to impact. But on the ESG side, from my perspective in compensation, only about 5% of companies have it in their long-term plan. They tend to have it in the short term. And the reason is, I've talked to boards, is that short term we can see increments of improvement and have reasonable targets. It's hard to have measurement over 3 or 4 years. Most of the things they want to see the progress, and that's how the capital allocations decided. But I think you're right. Most of these things, they don't get much growth or much progress in 1 year. So your perspective, I agree. Yeah.
I know in yesterday's panel, they discussed the differences between Europe and US in terms of regulations. So what should the US take in governing ESG, and on what level? Federal, state, perhaps even local?
Well, we just had a demonstration of that on March 27th, where the acting commissioner of the Security and Exchange Commission has now formally asked the Eighth Circuit not to go ahead with the hearings on the challenge to their disclosure requirements on ESG, which they put in back in 2004, and there's been litigation challenging overreach. And the current Republican, by the way, the SEC regulates disclosure, security law issues, especially compensation and other things you read in their annual reports. It's 5 members, and it's always 3 members, including the chair from the party in power. Now it's Republican. Paul Atkins is being nominated as the chair. They have no interest in having more regulation. So you're going to start seeing from the federal point of view, probably less, which may mean more at the state level. But at the federal level, you're not going to see much because they've already sent a signal that they're not going to go forward with enforcing the disclosure rules. Very different than Europe, very different.
I'll add to that, that we definitely see, I agree that we definitely see a lot more regulation, like top down, heavy-handed in Europe, Eurozone, and then less so in America. One of the recent study that we've done is look at the sustainability fund across the entire landscape. And guess what? So 70+% of the sustainability funds were actually incepted or, in European zones, because that's where the regulation is coming from. And you have to, adhere and comply to certain regulation. But when we look at the holdings of these funds within these sustainability funds, 70+% is actually in the US. So meaning like these funds were started in Europe, but they think the opportunity is actually in the US, which is kind of interesting, right? So there is definitely a balance between heavy-handed top-down regulation, which can stifle some of the innovation and be too rigid and not flexible enough to accommodate like ever-changing environment. But on the other hand, if there's absolutely no regulation, like for example, I think IRA is the right direction because really eliminate and lower some of the barrier for companies and industries to invest in innovative solutions. And that really helps. So I think there's a balance between the two. And also there's another example that I'll give you is that because of some of these regulations and, or ISSB, now is part of the accounting disclosure requirement, companies are increasingly disclosing more about their carbon emission. And that really helps with transparency. It helps with decision-making. It helps in terms of lower the cost of investment. So all of that, there's definitely benefit to some extent when there is, a coordinated universal standard, in the marketplace versus everybody's doing their own, which make it very hard to compare. So I would say, yeah, it's a balanced approach seems to be more reasonable. But it's interesting, like if you look around the world, the opportunities in the US, we'll see if that will continue with this tariff that is going on, but right now, as we speak, most of the opportunities are actually in the US.
And continuing along the lines of regulation, I mean, how do you prevent executives from gaming these ESG metrics and maximizing their bonuses without?
Yeah, so there are 2 ways that happens. One is corporate governance, and the executives don't decide their own pay. Board of directors usually have what's called a compensation committee, or in Europe it's called a remuneration committee. These are independent directors that have no financial affiliation with the company. They have to be truly independent. And they approve the compensation, they set the goals. It's a little hard to game because at that level, it all has to be disclosed annually. And those under a law we have called Sarbanes-Oxley, those are what's called filed, not furnished documents. So they're subject to penalties if they're not correct. So you might, in the goal setting, have some lower goals and all that, but whatever the goal is, that has to be disclosed and you have to talk about performance on it if you're going to make pay. Now it's retrospective, it's not prospective. It's usually when you're paying out, you say how they did. Most companies use what's called a scorecard. They'll have like 4 or 5 different factors that they assess, usually not in a formulaic way, but the judgment of the board. And that's usually how it's determined. But back to gaming, the only gaming that could happen is if management can get the board to agree to very low hurdles in terms of performance. But once you have that, the duty of care and the fiduciary duty of the board, they have to really do what their job is, which is to enforce pay for performance. So I think there's a little bit of mitigation and picking up on, I think, a point you were starting to move down, this whole transparency. that the more the disclosure, as an example, a proxy statement where you talk about pay, it's over 9,000 words, about 32 pages. There's so much detail. And so I think that helps a little bit with the enforcement of really the rigor of governance around this. I don't know that the objectives are as rigorous. I think there was a London School of Economics PwC study in Europe that said all these companies were talking about how great they were doing on ESG and the bonuses were looking good, but they didn't see any progress. So I think there's a little bit of disconnect between expectations and what companies are actually doing, especially as you pointed out in the short term.
And I agree with that what we've seen is that the approach is not just specific metrics and in a rigid way. The judgment really come into play in terms of the compensation committee. So it's not just black and white. They have to assess. Another thing I want to add is that given the fact that there are more and more information available, we also, from a practitioner's perspective, we got a lot of demand in terms of attribution.
Right.
So attribution is a very common, concept. Like in investment, if you have returns, you want to understand what is driving your returns. So it's what we call attribution. Now, one of the research effort that I personally happen to lead is called Attribution on Climate and ESG Metrics. So, and I'll just give you an example, right? So say, as an investment portfolio manager, I need to measure my portfolio carbon footprint. And I have certain, objective goal to decarbonize over time. As we know that portfolio level carbon footprint can be driven by many factors, in addition to the issuer at the company level, their emission progress. There could be transaction, portfolio value valuation, company, market value valuation, all of these other, factors that have nothing to do with the company emission progress that will impact the portfolio level emission for carbon footprint. So the attribution tool really help dissect and drill down into each of the specific drivers and really help, investment committee or the governance board to drill down into and analyze and understand what is driving it. And that will help them to determine what is the mechanism framework that we want to structure the compensation with. So that's what I mean by attribution. As a matter of fact, SFDR, which is regulation in Europe, they, require 63 indicators for a company to report. And 18 of them is mandatory. That include emission, that include, water, all of that, toxic, even men-women compensation discrepancy, right? Like that's fair pay. So all of these need to be disclosed by company. But guess what? They also have this requirement that year over year, company have to disclose what is changing and why it's changing that much. So I think this is the direction that we are heading, like not just the metric itself, but really understanding what's driving the metrics behind the scene. And then that can provide more transparency and for better governance framework in place that relate to.
Start getting into your research a little bit.
I'm very excited about research, as you can tell.
I know you've researched about ESG, sustainability. So the 3-part series, really digital pillars. Research, how you got into it, and share a little bit of your findings.
So first of all, I think ESG is a word that's a little bit misunderstood. So it's nothing but a way of categorizing and synthesize all of the sustainability data out there. And sustainability data, there are many of them, right? From emission, opportunity, clean tech, and then on the social, as mentioned, like the human capital, labor management, supply chain. And then on, governance, there's the compensation, the business ethics, accounting practices. Like there are many of them out there. It's just a way for us to synthesize and also identify what really matter. And I think you mentioned about it's really industry specifics, not, So the way that that we and the ESG is just a way that we kind of classify them in a way that is easier for people to comprehend and analyze and make sense of these data. So that's all there is. One of the latest, I think your question is how did I get into it and some of the research. initially I was on the sell side and buy side. So meaning like I worked on in the investment banking for a couple of years during the a great financial crisis. I worked on the buy side as well as portfolio management and also analyst. And increasingly I got you know, questions and demand to incorporate ESG consideration into portfolio construction. So that's, if you ask like how do I get into the line of research that I'm doing now, is really because of the demand from practitioners, from investors, that they require more and more of consideration to be incorporated. And then that's kind of switched me into the ESG and climate research area. I don't know if that answered the question.
I know, Charles, you've also done research on executive compensation. Do you mind sharing some of your findings and how you got?
Yeah, well, I actually dating myself in 1977, I wrote my doctoral dissertation on exec comp. The numbers were about that big. Of course, as you know, they're humongous. Average CEO in S&P 500 makes about 17 million a year. So the numbers have really gone up. But I did it just mainly, it was an econometric study to try to figure out what the real drivers were of pay from a size, performance, and human capital point of view. It's kind of interesting. There are hundreds of studies on exec comp, and we all agree on one thing only. Big companies pay more. So if you look at the scale of companies and such, so it's been an interesting thing, but lately I've spent time and I helped found the Center on Executive Compensation in Washington, where we do a lot of research and advocacy, testimony on the Hill, things like that. And it's really a powerful tool. And I think investors agree too, that it's a powerful tool for helping create value over time for companies. And the more that you can align the performance of the company and what you're paying for, you create value for what used to be just shareholders, now stakeholders. And so that's been a real interest. And where in my board work, where it keeps coming up is when they're asking about ESG. Very common question from a board, a compensation committee is, how should we think about ESG? Should that be in our pay program? How can we really think about the role of the board? And I like to suggest the best way is, what is it about ESG that's important to your business? You know, some companies that it isn't quite as impactful. I used to work at Pepsi, it's about water and plastic. That's different than an oil company. Then the next question is, can you set reasonable goals? Because to say it's important, that doesn't mean much unless you can set some goals, either short-term or long-term. And then how are you going to measure those goals? And what's the management process by which you get progress? Is it capital allocation? Is it your performance management system? Is it the technology you bring in? And then having said that, who's really going to impact? Is it in your operations? Is it your sourcing people, the supply chain? And then do you really think you need to put that in pay to make a difference? Because a lot of companies, their culture, Eli Lilly's a good one. They say, we don't want it in our incentive plan. If you're going to work at Eli Lilly and be an executive, this is very important to our company as part of our culture. You want to get promoted and have a good career, you're going to do the right thing around environmental and social issues. So those are sort of the decision model that we go through with companies. And in some companies, it's super important. Some companies, it's a blink. You know, some software companies, they ask, what am I doing to the environment? Or what are we doing in terms of sustainability? I'm sure they do things, especially now with AI and the energy use, but again, it's going to vary so much. But you need a conceptual framework for deciding if it's important. And if it is important, how are you going to make a difference? And then how do you reinforce that, whether you need pay or just your culture will help? This is sort of discussions I get.
To cut this discussion short. It has been a really blast. In the next 5 minutes, I need to move your yes. Do you have any question for our students or our distinguished panel?
You'll get the hard questions.
So now we're talking about a lot of like potential benefits of gyms.
Maybe we could use the
Yeah.
mic this for the questions.
Yeah, good point.
Thank you.
Hi. Okay, sure. So we talked a bit about like the potential benefits like of firms engaging in ESG, both in its operation as well as like the compensation. Do you see any potential drawbacks or risks for like companies adopting it, especially for like investors or like the company itself?
I can take a step
Sure.
first. I have this thing. I can take a step first. I'll give an example. There's definitely costs, a lot of them. One cost, an example that I will give is about, say, target, like emission target for companies, right? So there are more and more companies that disclose, but not only disclose, but also set emission targets for themselves. So in order to make progress towards these targets, companies have to make investments. And these investments in the short term will increase cost of financing, to be honest. Like this is what we've seen in the data. Companies, all else equal in terms of credit rating, duration, size, the companies that are making progress towards their targets have higher option adjusted spread, in another word, higher financing cost. And that's showing up in the data that we see, at least for the short term. But you can argue that these companies, if they are successful in navigating, then they will be at a better position because they will position better for the low carbon economy and the climate environment that we are getting into. So they should benefit over the long term. And that's a very hard problem for companies to solve, how to balance the short-term cost, which will increase their financing cost over like a long-term, competitive advantage that they are trying to build.
Yeah, and I think part of the risk too is shareholders and investors are not sort of a monolith. They have very different views. And in fact, last year, and we'll see what it is this year, I think it's going to be more. 2004, there were 78 anti-ESG proposals by shareholders submitting proposals to companies saying, we don't want you to pursue ESG. And a lot of those had to do with DEI and other issues, but luckily they got about 2.4% support from shareholders. By the way, any of you, if you own stock, you can submit a proposal to a company. If you own $2,000 worth of stock, you can submit a proposal that other shareholders vote on. And we're starting to see more in the anti-ESG area. So as a board, you're saying I've got one group who really wants us to pursue ESG. I've got another big group of shareholders and the attorney generals in red states and others who are deciding the investment. So you have to manage that. So one of the risks is really how do you please potentially conflicting input from different people who own your company and invest in your company. And by the way, BlackRock, which the CEO, Larry Fink, was sending all these letters out, how you have to be good stewards of the environment. And then Texas, Arizona said, well, you can't manage our pension funds and you can't underwrite our debt. And he said, ESG has been weaponized. We're not going to talk about that anymore. So you get these sort of pushes and pulls. Luckily we do MSCI and others who continue to do good research and really help with that. But some of the investors now are thinking about their own business, not so much of really being stewards, so to speak, of the beneficiaries whose money they're managing. It's a very complex thing at the board level, because often stakeholders have conflicting sort of views for it. And I'm sure you experience that in your research.
So
Yeah.
Yeah.
So thank you for sharing. So my question is back to Xinxin's point at the early of discussion. So we mentioned that companies that incorporate ESG or sustainability, like with the recent market valuation, actually outperform in the market. So is that saying that are you expecting more companies trying to incorporate ESG in the future to probably defend their position in the market, especially for small or mid-sized companies? Should they take this risk, considering they may have limited budget on investing in ESG? Should they also consider to incorporate ESG or sustainability strategy for their future accordingly. Thank you.
Great question. As Charles mentioned that for different industry, it's very different consideration. ESG, like what really matter. One of our latest blog that we just published a couple weeks ago, topic is which sustainability matter most, because it's not, the same for different industries. Charles mentioned that, for information technology, energy used to be not such a big consideration, but now with AI, the energy demand for these like data center is going to be huge. And people are even talking about like, some of these, AI, developer require a city's 1 year energy consumption to like power some of these things that they're doing. So there's going to be massive, energy shortage. So again, back to the point is that it's very industry specific. So, and that's kind of interesting thing I want to provide because we work with both investors and pensions, big pensions, that provide guidance on like what kind of things that we're looking for and for what criteria we're willing to invest. So obviously they are giving this carrot and stick, type of thing, and that will influence how the company will behave. Like, and give an example, if company, what we found in the data is that when companies ESG rating improved, their cost of financing, both in the equity market as well as the debt market, subsequently dropped. So meaning like it really impact their financing cost as well as their likelihood of being included in the index or not. What that means, like, one example is that Russia invaded Ukraine and Russia equities were all delisted from our index. And that's a huge blow to the valuation of Russian equities. If you think of it on an individual company level, when they do certain things, they may be included in the index. As a result, their shares may be traded at a premium or, a better price compared to their peer. And that is good for their CEOs, their senior management, and their shareholders. So there's definitely part of consideration from like an investor-driven approach. But then the other approach will be at the company level. What we've seen is that there is very clear empirical evidence that companies who prioritize these practices that matter for their particular industry tend to have higher dividend yield, higher profitability, and then higher earnings growth over time. So that's obviously, and the caveat here is correlation. So we can't establish causality, okay? Right. So people argue that it could be that companies are doing really well and they're flooded with cash and so they can invest in this program, vice versa. So that's the caveat I want to provide. But that definitely there's the other side of the argument as well. So both sides.
Yeah, I hope there are people in here who are really interested in this area and will continue the research, because right now it's not clear. There's some indication that it's a very positive thing, but just as you mentioned, it could be a luxury good that when you have more money, you can afford to invest more in that. But I think, again, we're generating interest at the university level in terms of the future researchers and leaders. And I think it's going to be exciting to see how this field evolves. Right now, it's just, we're barely getting wet in it. So I hope that some of you with good analytical skills that we teach here, that you'll really pursue this, because right now there's a lot of questions. And I think over time it'll become clearer. Right now we have hints that it makes a difference, positive difference, but we're not sure. Causation, correlation, sustain. What happens to a company's valuation when they back off? We don't have enough data to know. So I'm really looking forward to sort of all of you to give us some headlights on this. I think it'll be really an interesting area for a career.
Absolutely. I'll just add, it's a very exciting area. I'm having fun every day at my work. And there's also data that's coming from climate, and that's a very short period of time, right? Like, so the longest ESG index going back maybe 20 years, right? Like, and then if you look at the comprehensive ESG rating coverage from an MSCI perspective, that only is the last 11 years. So, and then when you look at a lot of these studies, it go back to decades, right? So 11 years is a short period of time. And by the way, that 11 years just happened to coincide with a very bullish market in general. Yeah. And, so it's hard sometimes to separate what is causing by ESG, what is causing by value, quality, some of the other very well-established factors. But it's a very exciting field. There's great expansion at the speed because of enabled by AI on climate, on physical risk, on transition risk, which is a big topic that we're trying to tackle these days. if you look at across the landscape, there are company providing like asset location data on very precise, where the asset's located and what kind of physical risk that it's subject to. It's a very exciting field to add to Charles.
Thank you, Xinxin and Charles, for the nice conclusion. And thank you, Fiona, Eric, and Arif for the nice presentation. And thank you all for participating in this section. Stick around. The next section is also about the executive compensation. Very exciting. Thank you all.